We got about 8 minutes until the bell ring. Let's go straight into our conversation with Kevin Kelly, founder and CEO at Benchmark Investments. Kevin, welcome back to Market on Close.
Oh, so good to be back, and always pizza, I agree.
Thank you, sir. I appreciate it. Me too. All right, so Kev, first thing that jumps out to me from your notes is that while elevations in stock valuations are still very high, they're not outrageous. Do you want to buy outrageous valuations or elevated valuations, Kevin?
Well, the beauty's in the eye of the beholder and how long you want to be that holder, right? And so if you think about if you're going to hold one of these stocks for 5, 10, 15 years, then maybe today's valuation is meaningless. That's why we go back to, do you want pizza or Chinese? Do you want, stocks or bonds? Do you want growth or value? And I think when you're looking at this market, sometimes I can see stocks with outrageous valuations, but I'd rather take on their asymmetric risk over the long term, knowing where they're going. I don't care about their, 200-day moving average because I'm going to own it for more than 200 days, right? Like that's the whole mindset behind this. And I go in my notes, I talk about the Nifty 50. What was one of the Nifty 50 stocks trading in the 60s and early 70s for like 100 PE? It was Disney, right? If you bought it then, you probably would have made money if you still own it today. So the whole mindset behind this market, and it's really frustrating when people talk to me about valuations. I'm like, compared to what? Compared to its 5-year historical or its 5-year growth. And so if you look at their earnings and you look at the economies they're operating in, you can go in hand over fist and buy them knowing that the economy that they're operating in is growing very significantly. The market that they're operating in, let's say it's e-commerce, is growing very significantly. And so, if you're paying 178 times earnings, who cares? Because this is the argument about Amazon, 5, 10 years ago, right? They were an e-commerce platform, okay? Now they're a data center company. So, pick your poison, right? You can complain about valuations all you want, but it's compared to what?
Yeah. So, Kevin, one of the stocks that you like, that you think has asymmetric risk, Genius Sports. You've had the CEO here on the show recently that provide essential data for sports betting applications and services. GENI is a ticker, traded below $10, got as high as 25. Right now we're 18. How come this one and not, say, a DraftKings or something?
Yeah, because this is a company that I would compare to the airline manufacturing market, right? There's Boeing and Airbus. They have a duopoly. The same thing with Genius Sports. They have a duopoly in the data behind sports, right? So it's Genius Sports as well as Sports Radar, okay? And so Genius Sports has come public via SPAC, and they have an exclusive with the NFL. And so in a reopening of trade, emerging economy, this is the reemergence. This is great to get in before all the sports betting happens. So you don't need to pick a FanDuel. You don't need to pick a DraftKings. They are their clients. They are completely dependent on Genius Sports, especially when it comes to the NFL. So this is a great company at $3.5 billion, market cap. And if we're getting legalized gambling all over the United States and also globally, I mean, you look at this company, they just signed a partnership with the Argentinian, sports federation for soccer, what they call football over there. So, they're dominating in football, not only domestically, but also internationally.
Hey, if you want to buy a gambling exposure, do you like Coinbase too, Kevin? Does that fit in to the theme?
Well, no, I would actually go to who Coinbase is dependent on, and that's Silvergate. They're at the actual bank. And so I would go that route as opposed to a Coinbase, right? Because Coinbase is going to need Silvergate. Silvergate doesn't need Coinbase. So that's how I would look at it. But sure. Coinbase, first mover, they got tons of competition, though. There's lots of regulatory environment. So go Silvergate as opposed to Coinbase, in my opinion.
Okay, so I was being a little bit tongue-in-cheek, but there is, I think, a point here, and I like it. Kevin, when you say that the valuations for stocks, and I like the Nifty 50 comparison because some of that stuff got so expensive, and then it obviously paid off in the long term for a good chunk of them. But there also are some plays in this market, and I use the crypto as an example because we have no real way to figure out what the actual value is for some of these tokens, but I know that's different, that's stocks. But there are companies that are pretty close to that borderline too, right? Where they're like flirting with not having any profits, losing money, not making any progress progress on that front? How much risk do you want to take on? I mean, are there parts of this market still that you don't want to dabble in, or is this like a ride the wave while the bubble's building?
It's absolutely not ride the wave. I mean, listen, for me, I think people need to understand their investments, and they need to look at them and say, is this a micro cap stock? Is this a mega cap stock? So I'm talking about broad markets, the large cap. You know, I think it's okay if you're looking at these because they're well-established players, but there's certainly scary things along the fringes where you need to be careful of, and you need to understand, right? MicroStrategy, that's really the Bitcoin ETF, right? I mean, they're leveraging up to own Bitcoin, right? You're not buying them for their fundamental business, you know, software or whatever else they provide on the fringes. So, you know, you need to be responsible for your own actions, and that's what this country needs to get back to. Do your homework, know what you own, and, you know, be accountable for it. Don't blame anybody else. So if you bought a stock and you had no idea and it went against you, good. You deserve that loss. You deserve to get your face ripped off.
Hey, one other one you like that has had a face-ripping rally for anyone trying to short it is ticker SEC Group Limited, based in Singapore, right? Internet company with exposure to various things, including, as you mentioned, football as well.
Yeah, so C Limited is a great way to play the sort of Amazon of Southeast Asia. And so recently they just got one of 4 banking licenses in Singapore. So great e-commerce company with tailwinds of fintech, as well as, so they've got fintech as well as gaming, right? Tencent's a big investor. And the way I think about them is that Southeast Asia, I mean, that consumer is growing. I mean, the amount of citizens that are entering the middle class and use their platform, and they are the premier leader. Who cares if you're buying it at a 52-week high? Because a year from now, it's going to be at another 52-week high. That's why I started getting involved in the name around 180, and I keep getting involved around the name. I just keep adding more, you know, in my retirement account, because guess what? I've got a long life to live, and, you know, when I retire, you know, I'll look back and say, hey, I'm glad I dollar cost averaged up into this name. As the Southeast economy is growing, more consumers are becoming middle class out there, and more people are addicted to the internet, whether it's e-commerce, gaming, or fintech. So SE, who cares about it being at a 52-week high? Get on in and enjoy the ride over the long term.
All right, there we go. I'm pumped up too now. Okay, thank you, Kevin Kelly. Good to catch up, sir. Nice way to close out this market today. Joining us from Benchmark Investments.